Get Rich Education is brought to you by Norada Real Estate, International Coffee Farms, and Corporate Direct.
Garrett Sutton here, Robert Kiyosaki's asset protection attorney and the author of Loopholes of Real Estate. As an American or foreign-based investor in U.S. real estate, you know we are a litigious society. You know that you need to protect your real estate and paper asset holdings with the right mix of LLCs and corporations. My firm, Corporate Direct, not only forms these entities, but importantly, we properly maintain them too. If you fail to follow the corporate formalities, you can lose it all in an instant. Corporate Direct is your source for LLC protection and maintenance in all 50 states. Visit corporatedirect.com or call 800-600-1760. Mention Get Rich Education for a free bonus. Switch your resident agent service to us and receive another bonus. It's all good. We look forward to assisting you at corporatedirect.com.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Hey, welcome to GRE. This is Get Rich Education, episode 85. I'm your host, Keith Weinhold, back to help you build durable wealth for yourself. How you doing? Last week, Robert Kiyosaki was here on the show to help us shape our minds so that we think more abundantly. If last week was about how to think, today is more about what to do, as we're talking about qualifying for investment property loans, also known as income property loans, rental properties with Graham Parham. Graham specializes in originating investment property loans, and he knows how you can position yourself to qualify for those loans, because not only is he a mortgage loan officer, but he is an income property investor himself. That's going to be today's show. Next week, Robert Kiyosaki's Rich Dad advisor for real estate, Ken McElroy, will be here with me. But today we're talking about all those things like what percent down payment does it take for you to get into an income property? What does your credit score need to be? What does your reserve requirement need to be? What's your debt to income ratio need to be? And all of that. And, now in most U.S. real estate markets, real estate prices have run up every year since, about 2010 or 2011 or 2012, depending on which metro area that we're talking about. So I'm going to ask today's guest about repositioning that bloated equity that you've got and what some considerations are when you're deciding whether to access that equity with a cash-out refinance or whether you should instead do a 1031 tax-deferred exchange. Well, now some people are asking here, how far can real estate prices run up? Okay, it's a valid question. Nobody really knows the answer. And you know what happened during the last real estate run-up that continued year after year after year in the U.S. in the late 1990s and the early to mid-2000s is, say, 1999 came around, prices had run up significantly over the previous year, and people already started asking the question, how much longer can price appreciation continue? And then it continued again in the year 2000. And then in the year 2000, people asked that question again, and it continued again in 2001. And 2002, and 2003, and 2004, and 2005, and 2006. And it wasn't until about 2007 until prices crumbled. So today, the difference is we have more responsible lending practices that prevailed. The reason that things toppled and teetered was primarily due to irresponsible lending practices. People first thought it was contained only to subprime lenders that didn't have great credit scores and all that. But like a contagious disease, it spread to other parts of the mortgage market. And we have more sustainable lending now. So let's find out more about just where the lending climate is today and meet today's guest. Graham Parham has been a mortgage loan officer for over 18 years with 25 years in sales and marketing. He is a leader of financial expertise in the North Texas residential real estate market. That's where he joins me from today. He's got quite a following, especially among real estate investors for income property. He's known and respected industry-wide. Graham's production consistently ranks him as a top producer in this marketplace. Welcome back to Get Rich Education, Highlands Residential Mortgage Loan Officer Graham Parham.
Hey, thanks, Keith. It's great to be here.
Yeah, it's really good to have you back. Now, we're talking about income property loans, Graham. So before we really get into it, I just want to be real clear for our listeners. We're talking about non-owner occupied loans here. Okay, these are loans for income properties where you're going ahead and renting those out to tenants. These are homes that the investor does not intend to occupy himself. And we're really just talking about four types of properties here today. Single-family homes that you're renting to others, and duplexes, triplexes, and fourplexes that are also non-owner occupied that are being rented to others. And really, Graham, what's gone on in the space historically? Like, where has the pendulum swung to? You know, about 10 years ago, all you needed was zero down, a heartbeat, and a signature, as we like to say, and you were going to get a loan. Where are we today as far as being strict or as far as being loose with our lending criteria?
I think that the industry itself is ready for, so to speak, loosening of the guidelines. I feel like Fannie is starting to recognize that more and more every day. I think a lot of the private investors that were in the game before, like your Wall Street lenders that were doing our Alt-A products, our subprime lending, they've got the flavor to get back in the game as well, but more on a conservative basis. So we're starting to see a couple of people step into the marketplace with their, as you say, Alt-A products, not necessarily a subprime, but maybe an alternate prime product that actually makes sense. But from the standpoint of Fannie Freddie, it's been pretty status quo for the last probably year. We just got a recent change in our compliance requirements, which is a thing called TRID, which everybody has to abide by. TRID is basically TILA RESPA integration disclosure. Before the TRID came down in October, we were all very familiar with a term called the good faith estimate. Okay, the good faith estimate terminology has gone away since then, according to Fannie and Freddie. We were all also familiar with a terminology called the HUD settlement statement that has also gone away since October, since the new TRID law came down. The bottom line impact of the TRID laws is that the government is trying to make sure that the consumer has enough time to understand everything they're doing in the transaction, which in my opinion is a good thing. Back in 2010, they came up with a good faith estimate where they took basically a one-page document that everybody could understand in layman's terms all the way down to how much they bring to the table to a three-page document, which quite frankly today, if you ask about a dozen loan officers, they're still going to have trouble trying to explain that three-page good faith estimate. So what they did is they actually converted that into a thing called the loan estimate, okay, which is very clear, very concise, and I think they did an excellent job with that. That very much mirrors what the new closing disclosure looks like from the standpoint of a HUD settlement statement. The only downside is that the closing disclosure has to be presented and acknowledged from the borrower 3 days prior to closing. Now, that's somewhat got the real estate community up in arms, especially for people that are buying owner-occupied properties and they got their vans sitting out front and the lender was very slow about putting the loan together.
Right. Now,
all of a sudden, they're clear to close and here comes this closing disclosure and they're still sitting in the hotel for another 3 days. Well, the good thing about it is our organization, we kind of get in front of the carriage. We as a lender actually have the ability to prepare the closing disclosure ourselves and send it to the borrower to have them acknowledge it to click off that time period. So that helps out significantly. Some lenders don't do that. They still rely on the title company to prepare the settlement statement. And sometimes when the lender will send their instructions to the title company to prepare that settlement statement, you know, they could be back and forth all day before it's finally approved. In this case, we're clicking off those 3 days, so we really don't miss closing. So that's really some of the bigger changes that have happened, and just recently is called the TRID law. Other than that, the only other thing I can think of that we're seeing kind of in the loosey-goosey world of Fannie Freddie is that on the reserve requirements, they have allowed for non-liquid assets to be counted as 100% of the full asset.
That's great news.
Yeah, before we were only counting 60% of the asset. If you had a 401k or an IRA that was worth, $10,000, we'd only give you like $6,000 of reserve. Okay, now we're giving you the full 10. So other than that, we expect to see, in my opinion, some more looser guidelines. I know there's a lot of things coming down the pike next month from Fannie and Freddie, mainly Fannie Mae, and I think that's going to help the world significantly, especially in the lending world, because I hear that's some of the points that they're going to be touching on.
Okay, wow. And we actually had a new, relatively easy to read government document in there that you mentioned. Okay, that's news in itself. Yeah, with one being able to use 100% of their reserves rather than just 60%, I mean, that's a significant answer to the question, is the pendulum getting looser or tighter? At least in that instance, it's looser. And, a lot of my listeners, and well, really me included, Graham, we want to get income property with as little out of pocket as possible. There's just so many reasons for that. That increases our leverage ratio, and that also enables us to borrow more at historically low rates. And we're usually getting those with low interest fixed loans. So in another consideration, before I ask you about percents down so that a borrower can put down as little as possible, I want to ask before I forget, what's the maximum amount of closing cost help that a borrower can get from the seller?
The maximum still is at 2%. 2% of the sales price seems to be, it's been around for, since Moby was a minnow. I don't know if that's ever going to change. Maybe some of the Alt-A products, when they come into play, they'll be making some change in that area, but I don't see anything changing in the Fannie and Freddie world. It's still going to be holding on at 2%.
Okay, that's really important. So if a borrower needs to put a minimum of 20% down on a property, closing costs are often maybe 4% of a property price, so they'd need to take out 24% out of pocket. But if they can get 2% closing cost help from the seller, maybe it's closer to 22% or so of the purchase price out of pocket. And of course, that number is going to vary a little bit by state. So what are the percents down requirements for conventional loans for income property today, Graham?
We do have the ability to put 15% down, but private mortgage does come into play. And I've run these numbers backwards and forwards. When you take a look at the adjustment in rate, because there's a rate adder for going above 20%, and also factoring in that PMI factor, that additional 5% that you're not putting down, it takes a long time to recoup that. So I always advise everybody to put at least 20% down on single families. On the 2 to 4 units, it's a minimum down of 25%. Now, the good thing is, since the mortgage meltdown in 2008, right before that, both Fannie Mae and Freddie Mac allowed for investors to go all the way up to 10 loans. And then when the mortgage meltdown hit, they had a knee jerk and they all came down to no more than 4. Well, after about 8 months, Fannie said, I think we're going to take it back up to 10. But when they did, they had a little more strict requirements. And the 3 strict requirements were, 1, instead of 20% down on a single family, we're going to increase to 25. And on the reserve requirements, instead of 2 months, we're going to take it up to 6 months. And also the 720 credit score is a minimum threshold. And that's the thing sometimes will have an influence on some investors. Good example is I did about 3 loans for a guy 2 months ago. So he just secured 3 loans. We got them funded. He added those 3 loans to his credit report. The credit report had a negative influence on the fact that he added these 3 loans. His credit score at the time was around 750. Because of adding those 3 new loans and 3 new liabilities, it brought his credit score down to about 710. Well, he wanted to buy more. He's in the 5 to 10 category. He couldn't do it because he had a hard stop at 720. Unfortunately, there was some changes back in October with Freddie Mac, which if you think about the number of loans that the industry itself will do today, it's usually about 7 to 8 Fannie Mae loans to 1 Freddie Mac. Not too many people will try to utilize Freddie Mac. It's just that, in my opinion, Fannie is a lot easier to work with. But Freddie decided to go ahead and extend the number of loans from 4 to 6, which having those thresholds all the way down to 620, 20% down, not, the reserve requirements aren't that strict. That kind of stretches out a little bit. So that helped that guy in that particular situation. So that's something that a lot of originators don't know today, even as of today, since October, that particular Freddie Mac guideline is in place and should be utilized, because I've done a bunch since I've discovered it.
Okay, these are some important planning considerations for investors here. And I guess the other component about qualifying for a loan is, let's talk a little bit about the DTI, the debt to income ratio.
That's an interesting question. What I've seen recently, and once again through Fannie Mae, when we gather information for a borrower, we put it into our loan originating platform. And everybody has certain platform, but when we try to get a decision from Fannie Mae, we all upload the same data into the loan originating system that's sponsored by Fannie Mae, which is called desktop underwriting. It gives us an answer within a period of seconds and comes back down and says, we like the file, we like the borrower, give us these items, and we go to close. When the Dodd-Frank Act came out, one of the things they stipulated is they wanted to have a hard stop of a 43% back-end debt-to-income ratio. But being they're still in conservatorship, there's a little loophole in there, which mainly says, okay, if we exceed that 43%, we can do it as long as the underwriting engine will accept it. Well, most recent days, and I don't know what's going on with Fannie, but I just approved one just yesterday at 49.87%, which is weird because other counterparts that do a lot of owner-occupied loans in our office, they can barely get above 45 on owner-occupied. So now Fannie's being more lenient on non-owner-occupied. I don't know if it has anything to do with the fact that it's 20 or 25% down, or they got great credit reserves, but we're able to push those limits up as high as that.
Okay, well, potentially that's another sign of some future loosening. Now, with respect to the debt-to-income ratio, which can hold back, a number of would-be investors from buying a property, sometimes a person might not have a down payment for a property. So what they'll do is they'll go ahead and originate a HELOC, a home equity line of credit, often as a second mortgage on one of their existing properties, and it might even be the home that they live in. But as soon as they originate that HELOC and have access to that cash, that also creates a new monthly payment for that borrower. So I would imagine that HELOC, new monthly payment, that's going to factor into the DTI and weigh an investor down as well.
It will, but not as much as you would think. I love HELOCs. I think they're great.
I do too.
I think everybody should have one. Simply, if you never use it, who cares? It's there for your purpose. Back before the market fell, I'm guessing 30% of the people on the West Coast, mainly in California, everybody had HELOCs. They're all tapping into their equity to put down on investment properties in other parts of the country. Well, after the market fell, a lot of the banks that had these HELOCs were shutting them down because the risk was so high. Getting HELOCs today on a primary residence is still a lot easier than it is on an investment property. Can you still get them on investment properties? Absolutely. Are they easy to get? I don't know. I haven't tried on investment properties, but I will tell you, go to your local bank. Don't go to a hybrid lender like myself because we're all first lien lenders. I would advise going to your local bank that you probably do your own banking with. Now, back to the debt to income part of it. What we're dealing with a lot of times is prime plus something, prime plus a half, prime plus 0, prime plus 1. But if you take a look at where prime is today and you put those adders on, the rates are extremely low. Consequently, the payment's low. And a lot of times, the payment that's kicking out on the credit report is just the interest part itself. Some lenders will take the credit report payment, and that's all they use. Some will require to see the promissory note showing, okay, we're going to take the worst case scenario, because a lot of times these HELOCs will change over time. Even though they're a variable rate, they have certain provisions inside the note. After 5 years, it can change to another type of a scenario, maybe a fixed rate at this particular rate. It varies from one HELOC to the next. But to have a negative impact like you would think it would do, it really doesn't.
Okay, just something I think of importance to mention to listeners about HELOCs that may not be aware of it. The Fed, although they've been moving very slowly, is inching toward raising rates. Those federal funds rate hikes, that directly hikes the prime rate, and that directly hikes HELOCs. So if you think that activity is going to continue, that will make your HELOC rate higher. And contrary to popular belief, those federal funds rate hikes do not directly affect mortgage rates like they do HELOC rates. We're talking about rates an awful lot here. A really important thing I need to bring up too is some that don't realize your interest rate is typically going to be higher for non-owner occupied properties like we're talking about here, because it's kind of a topic of risk premium to the lender, just like it is for an insurer. If you, as the borrower, don't live in that home and you're having trouble making the payments, you're more likely to default on that non-owner occupied income property than you are in your own home. So the lender wants to hedge against that. And the interest rate's typically about 0.5% higher historically for non-owner occupied homes as it is your primary residence. Is that still about right, Graham? Is it still about 0.5% higher?
I'm going to say, yeah, anywhere between 0.5 and 5/8, depending on the day, but that's a pretty accurate statement.
Okay. Now, when it comes to getting a loan, a lot of these properties that my listeners and I buy are in the Midwestern U.S. and in the South, in the Deep South. And a lot of those price points are lower. And sometimes for a bank, it's just not worth piddling around with a really tiny loan amount. What is the minimum loan amount that most are originating these days, Graham?
Well, that's kind of a moving target. It depends on the originator that you talk to. And here's what's taken place is because of all the restrictions and all the compliance, CFPB, the Dodd-Frank, everybody jumping in on this thing saying, okay, now we got to be more restrictive in how we do business. Consequently, that requires that all originating companies to employ more people to make sure they're doing things right, because needless to say, they don't want to be taken to court or being fined by the CFPB. Because of the additional staff, needless to say, it costs more money to do loans. That does filter down. And bottom line is, a lot of originators, because of the cost involved and how they regulate how originators are paid, a lot of times they don't even like to do loans less than $100,000. If you talk to a lot of originators, say, I've got a loan to do for $50,000, they say, I'm sorry, I just don't do it. This is my business. This is what I do. I work with investment property companies all over the nation, especially on the turnkey side. And yes, those price points can range anywhere from $80,000 to $125,000, and some markets even down price points in the 50s and 60s, which means they're going to fall down, below the $50,000 mark. I would love to say don't go below 50, but we actually do from time to time. You're not going to find a lot of originators out there that will do that.
Okay, this really helps with an investor's planning. One thing I want to ask you about that just popped into my head. Graham, last time you were on the show, it was almost a year ago. I like to ask an out-of-the-box question sometimes because financing really interests me. I asked you if you see amortizations going to any longer than 30 years anytime soon, and your answer at that time was no. Do you see amortizations, actually going away? Do you see the reintroduction of interest-only loans on income property anytime in the near future?
Well, that's hard to say because of the Dodd-Frank, and you'll have to read it. It basically is trying to get rid of the interest only, the 40-year terms, and because a lot of these things that are in place, and once again, it would have to be the guys outside of the Fannie Freddie box, coming up with loan products to do that. I'm looking at guidelines today on a fresh new alternate product that we just acquired, and there's nothing in there that addresses any interest only or 40-year terms. So the answer right now is I think that's going to be a while, or at least until maybe the new administration steps in and kind of takes another look at the Dodd-Frank and see if there's any way to make those changes.
Yeah, interest-only loans can often interest the borrower because that increases your cash flow if you're making an interest-only payment and not a principal and interest payment, but there's some other trade-offs that go into that as well. When Graham and I come back, I'm going to ask him if there are any financing considerations around what happens when you build up a lot of equity in a property and you're thinking about, do you want to do a cash-out refi or do you do a 1031? And also for the first time ever on this show, I'm going to ask a mortgage loan officer about FHA loan qualifications. I think it's how I started out, and you can get into a property as large as a fourplex with very little down. This is Get Rich Education. Our guest is Graham Parham. I'm your host, Keith Weinhold. We'll be right back. Now, this is something exciting. Through Get Rich Education and International Coffee Farms, you can once again own your own half-acre parcels of a passive income-generating coffee farm in Panama for as little as $13,000. This farm is going to be planted with the most in-demand varietals of specialty coffee in the market today. The farms are professionally managed for you on a turnkey basis, and you own the land. It's a low-risk opportunity with an average annual return projected at 12%, and that doesn't even include potential appreciation in the value of the land. These affordable raw land offerings are available only for Get Rich Education listeners through June 30th, and then if there are any parcels left at that time, the offer is going to go public. Parcels are allocated on a first-come, first-served basis. To learn more, just send an email with your contact info to coffee@getricheducation.com.
Are you looking for a roadmap to financial freedom? If so, we have a solution for you. Norada Real Estate is offering a limited number of free strategy sessions to help you get out of the rat race. Learn how you can create wealth and build monthly passive income. To set up a time with one of our knowledgeable investment counselors, simply go to noradarealestate.com. That's NORADA realestate.com.
This is Rich Dad Advisor Garrett Sutton. To grow your wealth, listen to the always valuable Get Rich Education.
Welcome back to Get Rich Education with our guest, Highlands Residential Mortgage Senior Loan Officer Graham Parham. So, Graham, we've had a significant appreciation in most U.S. real estate markets ever since, about 2010, coming out of the mortgage meltdown. Well, a number of investors have significant equity buildup in their properties, and they typically want to go ahead and pull that out because, as I often like to talk about on the show, the return from equity is actually zero. So what are some financing considerations when one looks to build their portfolio with more properties by using the funds in an existing investment property, between whether that investor should go ahead and think about doing a cash-out refinance on that property with all the equity or doing a 1031 exchange? What are some common trade-offs around that?
There's really several choices that you can go from. What's interesting is since 2008, prior to the meltdown, people were doing a bunch of 1031 exchanges because the market was appreciating so fast. Since the meltdown up until probably 18 months, 2 years ago, I haven't even done a 1031 exchange. Now they're starting to fall out of the trees again, which is good because people are cashing in those opportunities, selling those properties that they got a good deal on back. And let's just say even after the meltdown, now they're taking that equity and they're spreading it around, whether it be another property, another 2 or 3 properties. But I highly believe that that's, what's one of the number one things people are doing right now is the exchange. The other one is, let's just say that they just recently put 5 new loans on their belt and there's not a lot of equity in those investment properties. But let's say they live on the West Coast and all of a sudden their appreciation in their primary residence went up significantly. Well, they have 2 choices. You want to evaluate your primary residence loan to begin with to see where that stands. You might not want to touch it. You could be, 3.75%, 4%, whatever the case may be. Why disrupt that loan? So at that point, then you want to go ahead and take out that HELOC that we talked about earlier.
Right.
Go ahead and get your HELOC against your primary residence because it's easy to get, whether it be a 50, 100,000, whatever the case may be. Then take those dollars and cents and bring them to the markets that make sense to invest in. So there's really a choice of 3 there.
Yeah, that's right. Some novice investors think, oh, wait, I don't want to go refinance this property because I already have really good loan terms and a really low interest rate on that. Well, you can keep that in place, and often you can go ahead and add a second one. And I guess, Graham, a central question between this refinance or 1031 conundrum and decision is, what's the loan to value that one needs to maintain in a non-owner occupied property in order to do a cash-out refinance?
It's 80% on your primary residence, pretty much across the board. Some states differ from others. I'm just going mainly from Texas because Texas law prohibits us from not going and exceeding above 80%. But if you look at the guidelines on a national basis for all lenders, I think they're pretty much right there in other states. So I can't really say I haven't done a cash out loan in other states for any other clients of mine to take money out. But I think 80% is a good threshold. Plus, it keeps you away from having any PMI requirements. And if you're going to cash out on your investment properties, you're probably looking at a 75% loan to value on a single family.
Okay, so you need to keep 25% equity in a single family income property for your cash out refi consideration.
Correct.
Now, you have some top questions from borrowers, kind of some things that you brought up to me that dealing with all these investors, some common things that they can help get educated on to make their loan go smoother and to help them put more properties in their investment portfolio. You had the seasoning for a cash-out refinance. Tell us about the seasoning.
Well, a lot of times, let's take some newbies as an example. Let's take a kid right out of college, got his new job, making good money, hasn't really started a family yet, but he wants to invest. Mom and dad have, 5 or 10 investment properties and want to help out son on his first investment property. Well, they're going to give him, say, $20,000, $30,000, $40,000. Here, go invest. Well, guess what? That's a gift. The parents gifted that money to the son. In non-owner occupied world of lending, gifts are not allowed. They're only allowed on primary residence transactions, which means if we take a look at his last 2 months of bank statements and we see this large deposit on there, we're going to need to know where it comes from. And, of course, he comes back and says, well, mom and dad gave it to me. Then I'm going to say, I'm sorry, I can't do the loan. But if we were to look at the bank statements after, say, 3 months, and there is no large deposit on there, there's no way an underwriter can second guess where that money came from. They can only assume that it's his money. Okay, so typically it's a 2 months bank statement. So we always say it's a 60-day seasoning.
Okay. Now, one other problem some borrowers have is meeting the credit score criterion. Tell us a little bit about Rapid Rescore. How does that help somebody with credit score problems?
Rapid Rescore has been around for several years now. A lot of the good originators will use it because it does make sense. a lot of the tri-pool companies that are out there that a lot of the originating companies will use have that ability to do a rapid rescore. And I've used it many times over, and I'm going to say 99% of the time it works. Good example, like we talked about earlier in the show, where a gentleman added 3 additional properties. He had a 750 credit score, and now all of a sudden the 3 properties are added to the credit report, dropped him down to 710. He's trying to do property number 6 or 7, and he needs that 720 credit score, and it's not there. Well, what we'll do is we'll run an analyzer, so to speak, within the tri-pool company, and it'll go in and examine the credit report, and it'll come back with answers. Say, okay, if you pay this particular credit card down to this particular level, or you pay this one off, or whatever the case may be, it's typically paying some of the debt down to improve the score. It'll give us answers. We'll take those answers back to the borrower and say, we do have the ability to improve your score, but you're going to have to take some of that additional money that you have and pay some of these credit cards off or pay a car off or whatever the case may be. And typically when that happens, we'll get a letter from the creditor showing that they did, in fact, pay those down or off. We'll send those to the tri-pool company. They will update the information. We repull the credit. The next thing you know, we're back above 720. So it really does work. It's called rapid rescoring. And most of the originators out there pretty much know how to run it.
So, Graham, do you run into people with a lot of questions about LLCs and how to structure things with LLCs?
I do. I have to go on and off the record. I can only tell you what I do personally, but I can also tell you what's required in the Fannie Freddie world. Fannie Mae and Freddie Mac, when it comes to issuing a loan, they can only issue a loan to your individual names. And if they want to bring in a family trust, that's also allowed as long as it's a revocable trust. But they will not do entitlement of the property in LLC, S Corp, limited partnership. They just won't, because one of the things they can't do is they can't pull credit on a company. Okay, so they have to make sure that the borrowers themselves securing the loan. What typically will happen in today's world, because there's a lot of people out there promoting asset protection. I personally believe in asset protection. I've got 14 properties, and all of my properties are in an LLC. Now, I can't promote this, and I can't tell people what to do, but what I personally do is once I fund on my loan in my personal name, I'll send over my deed of trust to my attorney, and he'll immediately, retitle that into my LLC. Now, one of the things I open myself up to is a thing called the due on sale clause, which is in every promissory note, both Fannie and Freddie, which means if you change the entitlement of the property, you have to inform the servicer of it, and that servicer has the potential to call the note due. Now, I've been doing this for 20 years, and if I had $1 for every time I had this conversation, I'd have a lot of money. But the majority of all of my clients will pretty much do the same thing as described. Once again, I cannot promote that or tell you what to do, but I've never seen a note called due.
You never see it happen. Yeah.
Never. If you stop making payment on the note, that's when it's going to be called due. Or unless, of course, you want to pick up the phone and call the servicer and talk to the customer service department and say, hey, guess what I'm doing today?
There's more fun conversations to have. Yeah.
Exactly. But I think LLCs are great. The only time that you got to be careful about is when you're doing an exchange. And if I was in a room full of investors, and first thing I ask is anybody doing an exchange? And if I get a hand raised, and the first question out of my mouth is it entitled in your name, or is it in anything other than your name? And a lot of times they'll say, no, it's in my LLC. Well, the way the exchangers work is they have to go like as, which means that they have to go from it's entitled when they sell the property to whatever it needs to be entitled to the new property. If it's ABC LLC sold, then they have to entitle the new property or properties in ABC LLC. Well, that's a problem because, as we mentioned earlier, Fannie and Freddie does not do that. So a lot of times what individuals will do is they'll take their entitlement of whatever property they're looking to sell out of the exchange and put it back into their personal name. I've seen several conversations with accountants, with attorneys, that sometimes will agree or strongly disagree with this practice, but you'll have to get with your CPA in regards to that. But it can be done. But that is the only way it's going to be done successfully with an exchange, especially if you're using a Fannie or Freddie product.
Okay. Now, one question that commonly comes up when an investor is looking to originate a loan is, can a husband do a loan without the wife or vice versa, or do they both need to be on that application?
Great question. a lot of the people's kind of a misnomer. They think, especially if they're living in a community state, thinking they have to have their wife on the loan. Sometimes the wife doesn't want to be involved. So what happens is that the husband actually can do it on his own. He does not have to have his wife on there. Even though they're living in a community state, the non-owner occupied transactions do not require that the spouse be on the loan. And that's all the way to entitlement. He can do it from beginning to end strictly on his own. Now, the only thing that I caution you about is, let's say that we're looking at the cash funds to close and some of the bank statements has her name on it. Well, if we look at that, we're going to have permission from her to allow the husband to utilize those funds for the real estate transaction.
Right.
So typically what we'll do is just get kind of a quick access letter. The wife will write something to whom may concern, my husband can use these funds for any real estate transaction, and we're good to go. So that's the only other downside of not having the wife involved.
Okay, Graham. Now, you were last on Get Rich Education almost 1 year ago, and you were telling us that something's coming about a good financing program for when you're trying to finance over 10 properties to the same borrower. Tell us about that.
We had one, which quite frankly, at one time, I think the rates were ridiculous. And you have to understand, these particular products are non-Freddie products. They're from private investors. And, if they see a niche, they want to get paid for it. So the one particular private investor that we had, they wanted a little bit too much for the rates. So we're not able to successfully sell a lot of those. We just launched one this week, which I think we're going to have some attractive rates associated to it. Now, keep in mind, they're still going to be higher than the normal market rates, where you're looking at, in today's world, say 4.5% to 5% as a range. We're probably looking somewhere in the sixes, maybe middle sixes. But if you think about when investors were investing prior to, say, the 90s or 80s, that's still a very attractive rate for them.
Right.
But the fact of the matter is, we still can go above the 10 up to 20, and they'll let you do 20% down, and we can get minimum credit scores all the way down to 560, which is kind of interesting. Basically, what I'm advising people to do, if they have a need to go above 10 properties, I advise them to give me a call, and I can discuss the full program. Like I say, this thing came out just this week. I haven't even had a chance to talk to any of my investors regarding this because I want to make sure we have everything in order.
Okay. That sounds pretty good. Now, I wanted to ask you about FHA loans, Federal Housing Administration loans. I think most of my listeners know I famously got into real estate investing kind of half accidentally when I bought a fourplex building where I lived in one unit, rented out the other three, and controlled that entire property with just a 3.5% down payment as long as I lived there and owner occupied it myself for the first 12 months. So what does the FHA loan qualification program, what does that look like today?
That's interesting, Keith, because that's somewhat of a sleeper concept, what you did.
Yeah.
I've been doing this for 20 years, and I think if I've done a FHA loan for a 2 to 4plex, I'd maybe be 2, simply because it's just not something that people know about. The only way they would know about it, obviously, is listening to radio shows like this or having dad saying, hey, I can give you some money. Go buy this duplex or fourplex, you'll move into it because FHA allows you to do so, because all of FHA loans are owner-occupied transactions. They do not do investment properties.
Right.
But if you're moving into a duplex, well, needless to say, you're going to rent out the other side. Same with a fourplex, okay? So somebody that's trying to get into the business and trying to generate some income and be an investor, this is an excellent opportunity with a minimum down of 3.5%, which is crazy. The other crazy things about it is, we talked about gifts earlier, that you cannot receive a gift from mom or dad. You have to have the seasoning requirements. FHA, you don't have that. You can get a full gift for down payment and closing cost from dad, okay? Now, keep in mind, if you're married, we talked about the joint spouse a minute ago, that you had to be a part of the transaction. Well, now that part comes back into play on FHA. Let's say the wife had really bad credit, like in the 4s, okay? But the primary borrower, which is the husband, he had great credit. Well, FHA requirements require us to at least to use her debt. We don't necessarily have to use her score, but we have to use any debts that are involved with her. Now, if they're joint debts and she's got good credit, well, then put her on the loan as well. Not a big deal. So I just want to make sure that they understand that you still have to bring the spouse's debt in onto that, and she, in fact, does have to go entitled. The other things that are cool, they do give you credit for the other side of the portions of those units, whether it be a 2 to 4 credit back for rental. We'll just get an appraisal done with an operating income information on there that will give us that, and or the leases, whichever is there, and we'll still give you 75% of whatever that full gross lease is.
Okay, so those are some great considerations. So it's still a 3.5% down payment. I know the FICO scores are quite forgiving in that you don't need a very high score to get in. And of course, since you're putting less than 20% down, there still is that private mortgage insurance premium that you're going to have to pay monthly. And we got the 12-month owner occupancy requirement. And it sounds like the FHA program is also pretty forgiving as far as getting a gift to come up with a down payment too. So that's really encouraging. And, I think I just want to tell my listeners that what we're talking about right here, an FHA loan, putting 3.5% down, where here in 2016, Graham just told us that you can even use 75% of the rent income from the other occupants of the building. I mean, this is what gets me excited. I mean, Get Rich Education, it's about how can I make you more successful than me, faster than me. Basically, you're using other people's money in the form of those tenants' money before you even close on the building toward your qualification. Most people work for money. Some people think their best and highest use of the dollars is getting other people's money to work for them. But with something like an FHA loan, you're getting so much of other people's money working for you. You're getting the tenant's rent income, and you're getting the tenant's rent income just to use as qualification for the building. Plus, you're borrowing at 96.5% when you put only 3.5% down. Your leverage ratio is 28-1, and it's really a great, great way to amplify your wealth. And you can do these FHA loans with a single-family home, a duplex, a triplex, or a fourplex. So that's just something very personal to me because that's how I started out. And I know it can make a huge difference in your life if you buy right. Now, Graham, how many states do you currently operate in? How many states can you do loans in?
Right now, 8. I'm in Texas, Tennessee, Missouri, Kansas, Indiana, Georgia, Florida, California, and Alabama. If you live in any of the other states, but you're financing a loan in those particular states and the properties in those states, not a problem. We can help you out in all those states.
Okay, so there are some very popular investor states in there. So the borrower can live in any of the 50 states, but we're just talking about where that property is physically located. You can help them out in any of those 8 states. And if you're a foreign national and you're a foreign buyer, go ahead and get a hold of Graham, and he can tell you more about how he can help you there. Graham, how can our listeners find out more about you?
Well, you can call me directly at my toll-free number, which is 855-326-6802. Or each one of those states has its own separate web address, which is, as an example, Alabama, which would be Alabama Investor Loans. Florida Investor Loans. They're all state-specific. One of the things I would encourage you to do is do go to the websites, whichever states you want to go to. There's actually a free guide on there that I kind of wrote up to kind of help address some of the things we've talked about today on the show, as well as other things that newbies can understand as far as the processing and understand what it's going to take to get a loan. I drew this up this year. It's called the Investor Loan Guide. Just download that. It's free. Highly recommend to do that.
Well, it was great to have you back again, Graham. You gave us a lot of things to consider as we position ourselves for our next loan and expanding our portfolio. Graham Parham, thanks so much for coming back on to Get Rich Education.
Thank you. Take care.
Yeah, all right. Great to get an update on where we're at today. So, okay, say now like back in 2006, all right? Just imagine in 2006, you are a house painter and you're making $45,000 a year, okay? You could qualify for a loan then, maybe merely by stating your income on your loan application, just writing down whatever it is, and you didn't have to have any hard backup to validate what your income really was, okay? And you know what? Maybe no one's actually even reading your application back then anyway, okay? Those were the wild and crazy, loose, anything goes days, okay? And maybe someone with that $45,000 a year salary, maybe they could qualify for a $600,000 home on that salary. Oh, and also get it with zero down, okay? You might even get a 105% loan to value loan on your home, okay? On the $600,000 home, meaning that you would get lent $630,000, okay? $600K for the home and $30K for you to spend as you pleased. It was out of control, okay? Well, when that cracked apart after the 2008-2009 mortgage meltdown, things got quite strict. President Obama signed the Dodd-Frank Act in 2010, and that made big changes to financial regulation in the U.S., okay? So the pendulum after Dodd-Frank, that was fully in the tight mortgage lending position. And, a lot of people agree it was too tight for a while because it was really hard to get a loan. and now it's swinging away from the tight side somewhat. So let's look some more at how it's changing and just recap a little bit of what Graham and I discussed, okay? So just about a year ago, you could use only 60% of your 401k balance as reserves. Now it's up to 100%. And of course, I hope you haven't been over-contributing to your 401k. You know, I don't think much of 401ks when it comes to building wealth for yourself. For years, your first 4 conventionally financed properties had the easier qualification criteria. Those first 4 had both a lower minimum percent down payment, usually 20%, and it was also easier on the reserve requirement as well. And then after those first 4, you needed to put a higher percent down, usually 25%, on rental single-family homes, rather than just 20%. Well, now those easier qualification criteria are extended from your first 4 properties up to your first 6. Yeah, so now you can put 20% on the first 6 rental single-family homes anyway, rather than the first 4. An easier credit score requirement for your first 6 properties is in place now, rather than just your first 4 as well. That is good news for you. You're able to create more leverage with less down. Now, the FHA loan that got me started with 3.5% down on a 4-plex, that still lives on today, and I love that you can still take advantage of that. If you buy right, you are really amplifying your wealth with so little down. Kind of a sleeper technique is how Graham put it. If you want to look up Graham Parham for your financing needs, like my friends and I have, his contact info is also in the show notes. Next week, I'm giving you more perspective on building your wealth through real estate investing with Robert Kiyosaki's Rich Dad real estate advisor, Ken McElroy, as he'll be making his second GRE appearance next week. Until next Friday, I'm your host, Keith Weinhold. Don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing. If you enjoyed the show, please take a minute to visit iTunes and leave your comments.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.